Good evening, everyone, and welcome to our second webinar in our most recent series. I'm Mark McAllister, Senior Partner for Holben Assets based here in Cape Town, and I've been helping returning South Africans get financially fit to return for the last 5 years. Please feel free to connect with me on all of the social media channels above so that you can receive the latest updates when getting financially fit to return. This evening's webinar is designed to help South Africans who are either planning to or have returned home recently to understand a bit more about their financial options. It includes some of the better experiences and lessons learned from others who have trodden this well-worn path. In the very least, I hope today will provide some more value to those who want to know a bit more about UK pensions for those who are thinking about returning shortly. Thanks for taking the time to join us tonight, and we hope to see you back at at our last event shown here on the 24th of June, which is a general wrap up on getting financially fit to return. Okay, so here's what we're going to cover tonight. So start off with a bit of an introduction. What is a UK pension? The different types of UK pension, and how you take benefit. Taxation of UK pensions and the options for returning South Africans. And lastly, one of the free pension MOT services that we offer here at Holben. There is a section at the end for answering questions, and I would request that you utilize the Q&A button. It's in the center of your screen at the bottom, and feel free to ask any questions along the way, and I'll do my best to answer them at the very end. Thank you again, though, for taking part this evening. Okay, so let's get started. So to give you some background about our company, by way of introduction for those who haven't attended the first webinar, Holben Assets is the second largest independently owned financial advisory business globally, and we've been around since 1998. We manage and administrate nearly $2.5 billion for nearly 30,000 clients in over 30 countries, from offices in 11 different countries. We specialize in helping expats with their finances, and in particular, those who have worked in places like the UK to resettle in their home countries like South Africa. Now, in South Africa, we have offices in Johannesburg, Durban, and Cape Town, which is where I am this evening, and I'm also senior partner for Cape Town for the group. So what is a UK pension? Well, a pension is a tax-efficient vehicle to help you grow and protect your savings during your working life to provide for your retirement after you finish your career. You're encouraged to do so through tax incentives so that you aren't a burden on the state. For example, the company and the government will often add to your pension pot for everything that you pay in as well. So normally all of the payments have some element of tax relief, but when you reach retirement, you'll often pay income tax on what comes out. Some pensions provide you with a pot of cash that you can use at a certain age, normally about 55 years of age, and others provide you an ongoing regular income throughout your retirement. Whilst you're abroad, it's likely you or your company will have paid into a private pension scheme. Perhaps you have a number from various different companies dotted around. After your property, your pension pot is likely to be your second largest asset, and it's almost certain you'll be entitled to some form of state pension from the UK government as well. You may not be aware of this, but there are an estimated £19 billion in unclaimed pension pots. One of them could be yours. Not much has changed in UK pensions since the pension freedoms came about in 2006. But actually in March 2017, the law in the UK changed so that if you would wish to transfer your pension outside of the UK, somewhere more favorable before, and you live in South Africa, now it's very common that you'll have to pay a 25% exit tax to do so, which obviously isn't ideal. It's been perceived as a way of reducing a large number of overseas transfers, which obviously would have taken the money outside of the UK government's control. Now, the UK's pension system is under significant strain due to its aging population and low interest rates, poor pension fund performance, and also many schemes are in deficit. So you have to ask yourself the question, do you want to risk your pension being devalued by the UK government or ending up insolvent? So just here's a quick stat. The PwC predicts that 5% of big company pension funds could fail, just like British Home Stores, Monarch, and more recently, Carillion. And these deficits in a number of the company pension funds are some of the highest levels since the financial crisis, but a little bit more on that later. So there are three main types of UK pension. I'm going to talk through them one at a time. So firstly, the state pension, which is provided by the UK government, even after you come back to South Africa. Secondly, defined contribution schemes. And finally, defined benefit schemes. So a lot of people ask about the state pension. Basically, if you've paid into it for about 35 qualifying years, you will get the new state pension. A male on a full pension will get £175 a week, or about £9,100 per annum. You will, however, get less money if you haven't paid in enough years. So typically, this will be from age 68, depending on your age when you were born. This might be sooner. And also, if you haven't contributed sufficient funds or are missing years of contributions, you can make up the missing payments at a cost of about £800 a year. If you want to find out the status of your national insurance payments and the state pension entitlement, you can do so very easily online by going to www.gov.uk/check-state-pension. Right, let's move on to talking about private or work-related pensions. When we think about pensions, imagine they are there to provide getting you to a retirement destination. So in your case, if you're listening to this, it's probably South Africa, which is relatively, has a relatively cheap cost of living, better quality of weather, nicer wine, and the ability maybe to be a swallow. So spending a bit of time in the UK and maybe some time down in South Africa, either ends of the year in perpetual summer. Now, let's imagine what mode of transport you can use to make that journey. That's the yellow line in front of you. Well, private pensions are normally one of three types of vehicle for that journey. Okay, it could be a tank. It's well armored. It's designed to defend you against the outside world, but it's slow, and it will take you a long time to get to your destination. A car is the most common and reliable form of transport. It's cheap, but imagine this. What if the car you had to drive was a Ford Mondeo? You had to go at 55 miles an hour in the middle lane of the motorway. What if it had to have 4 doors and it had to have a 1.4 litre engine? Well, most people's private pensions or workplace pensions in the UK fall into this category. What if you wanted to have a different color, or you want to go a little bit faster or slower? You maybe want to have 2 doors rather than 4, or perhaps a bigger engine. Question you have to ask yourself is, wouldn't you rather have a bit more choice? Finally, pension could be a jet fighter. It could be fast, it could be expensive and first to the destination, but there's also a high risk it could fall out of the sky. So that one's probably only for jet fighter pilots and should be left well alone. So let's start off with the older defined benefit schemes, which are often known as final salary, or sometimes referred to as gold-plated schemes. Now, these were designed in a long time ago, in a bygone era. It's when people pretty much stayed with the lives and then retired, having been retired, and then these schemes have been phased out in favor of more common defined contribution schemes. They're generally slow, low risk, and very safe, like the tank in the analogy that I described before. I described it in a way that it makes sense, but one of the things you have to think about is the host scheme financially secure, and a bit more on that later. So it's a promise to pay. It's not a pot of money, but instead that promise to pay an amount on an ongoing basis at a date in the future. That amount is normally fixed, but then rises with inflation. It might be CPI, it might be RPI, depending on your final salary, or maybe even an average salary, or your contractual arrangements. Many of the schemes are now in significant deficit, and are having to take some pretty drastic action to meet their future obligations, such as topping up assets or changing the arrangements within the scheme. So let's take an example to show you how a defined benefit pension works. If you've got one of these, I'm sure you know all about it, but let me just walk you through the example. So let's imagine we've got Fred here. He's been at ABC Manufacturing. He moved on from that at, say, age 40 years of age, and he's come back to South Africa. And now, 20 years later, he's age 60, and he wishes to get access to his defined benefit from his pension fund. Now, his defined benefit pension entitles him to £10,000 a year. That's going to rise with inflation, and that's the promise to pay each year from the pension trustees. They have a large amount of money they have accumulated, and let's say it's it's a really safe, bulletproof style investment. So it'd probably be in things like government debt, so lending money to the likes of the UK government. Let's also, for the sake of simplicity, say that those investments would, say, I don't know, yield maybe 1% a year in the current environment that we're in. So to get Fred his £10,000 a year payout, the trustees need to have about £1 million in assets, within those investments to meet their obligation to Fred, which hopefully all makes sense. Now, Fred obviously doesn't necessarily care about what the pension fund holds, doesn't really need to know about it. He's only really interested in getting his annual payment each year. Okay, so let's now say that market conditions have changed. Okay, let's say that super safe investment, that was returning 1% a year, now it's only returning 0.5% a year. Obviously, Fred still isn't that interested, really. It's not going to affect him. He's still entitled to his £10,000 a year. But to get Fred his £10,000 a year, the pension trustees need to find £2 million in assets. And that's so that at a yield of 0.5%, they can still get him his £10,000 a year. Hopefully that makes sense and you're all still following me okay. Now, if that investment yield drops by another 0.25% down to 0.25%, because let's say, I don't know, interest rates have gone through the floor during a coronavirus pandemic, the trustees now need an extra £2 million on top of the figure before. So £4 million in this example to still pay Fred his £10,000 a year. Quite frightening, right? And that's what we mean when we say that a scheme is in deficit. And as the result, it may not have enough money to pay Fred if it can't get more payments or contributions into the pension fund, depending on how it's structured. So this is actually one of the primary reasons for BHS failing back in 2017 as a real world example. You might remember reading about that in the news. Okay, so let's not try to depress everyone too much. So let's go back to our original example, and instead let's talk about what happens now, unfortunately, when Fred sadly passes on. So Fred leaves behind his wife, Wilma, who's 60 years of age, and you'd probably expect that Fred's pension would pass on to Wilma in its entirety. Well, sadly not. The norm is that somewhere between 50 and 60% would get passed on to the spouse. So Wilma is now only getting about £5,000 a year of income, as opposed to £10,000 a year if Fred was still alive. Let's just press everyone a little bit further. Imagine what happens now if Wilma passes away. So when Wilma passes away shortly after Fred, the two children, and no bonuses for guessing what their names are left left behind, obviously. So assuming that they are under the age of 18, it's fairly certain they will get some form of income. And most schemes will allow some kind of a payment up to the age of 21. But normally this spousal amount depends on the rules of the scheme. So it's probably going to be that £5,000 a year that Wilma had. If, however, the kids are grown up with Fred at age 60, that's pretty likely. Guess what? The pension effectively will die at that point. So quite often, one of the ways you could view it is that the pension would effectively die with the second spouse, and zero is passed on to the children. So it doesn't sound so gold-plated anymore. I'm sure that's what you're thinking. Okay, so let's rewind that situation. Imagine Fred is still in his 40s. Okay, so maybe he's watching now and he's thinking about what 20 years in the future might look like. And we're in this current pandemic situation that we're in right now. So the trustees know that they don't have to pay Fred until his 60s, okay? So they've got 20 years of time, but they still have to provision that amount of money for Fred's retirement. So, bearing in mind the current market conditions, the scheme might be in deficit. So what can the trustees do? Well, a lot of them make a commercial decision. And if asked, they're going to offer a figure to effectively buy themselves out to pay. At the moment, this is normally a figure somewhere and 40 times what Fred can expect in retirement. It's a bit more complicated than that, obviously, but let's try and keep this simple as possible as we can for the purpose of this webinar. Fred could effectively get access to a cash pot that might have a value of somewhere between £200,000 and £400,000 today at age 40 years of age. Now, he can't get access to that cash, unfortunately. It has to go into another UK regulated pension scheme, but it does mean that the cash is his to do with within that pension scheme as he wishes, if he wants to. Let's rewind this. Let's now imagine that Fred takes that £400,000 of cash at age 40, and then next 20 odd years, a very conservative 5% a year. And now we get to his 60th birthday like we did before. Okay, well, now what have we got? Well, we've got some pension assets. Okay, we're going to potentially draw down circa 5% a year. But because of how the assets have grown over that 20 years, Fred's now got £1,080,000 sat in his UK private pension fund. So if he decides to take 5% of that a year via drawdown, it's going to generate him a little over £50,000 a year, 52,500 in this example, which, obviously, as we know, is a much higher figure than the £10,000 that he was going to get before. What's quite interesting, though, is that if he dies, Wilma would get the whole fund. That's over 10 times improvement to the £5,000 a year that she would have got from the defined benefit arrangement. And if Wilma then passes away, the children will now inherit the whole pot, which in this example is £1,080,000 as opposed to zero. So quite a compelling thing to think about. So to wrap up our defined benefits section, I've included this news article. If what I've explained sounds too good to be true, I always look to the people in charge of the system and follow what they do. So, for example, here in 2017, you'll see that a former government pensions minister transferred her defined benefit pension. So when people like that are doing that, maybe it's something that you should be thinking about as well. Okay, so the other main type of pension fund is referred to as a defined contribution or money purchase scheme. Here you'll probably have regularly contributed into a pot of cash held for your retirement by a pension company. This is the car example I used in the earlier analogy. So this pot of cash gets tax relief when you add funds into it with help from your employer and the government, and they normally then grow that figure by buying investment fund units. All the growth inside the pension is tax-free. It will continue to grow even without any further contribution. So if you leave the UK and come back to South Africa, it should still keep growing. And the rate at which is determined by what funds it's invested in, which is kind of like the engine in that car. Common pension trustees that we often interact with are the likes of Aegon, Aviva, Standard Life, and Willis Towers Watson. And typical top to bottom costs are normally somewhere between 1% and 3%, depending on the provider that you have your pension with. Typical growths for growth projections sit at somewhere between -1% and 5.4% a year. And they're very generic and homogenized to save costs. So you're very much in the same vehicle as everyone else. They normally have restricted funds lists. That's normally where those companies make their money, is through actually the management of the assets. So you'll be encouraged to have a Standard Life or an Aviva fund held underneath the structure. And the whole pot can be left 100% of it to your beneficiaries. So that might be your spouse or it might be your children. When it comes to taking your pension benefit, this is what we call taking benefit. So legally, this is normally from age 55, but with a lot of defined benefit schemes, there will be a restriction on that, and you probably only be able to access it maybe from age 60 or maybe even higher. The defined contribution scheme is very flexible. Again, access is from 55. And then the first payment from a pension scheme is normally called the PCLS. Try not to have too much jargon in these webinars, but it stands for Pension Commencement Lump Sum. And it's normally a 25% tax-free lump sum. After that, then you've got three options on what you do with the remaining amount up to 75%. You could take an annuity, which is effectively kind of like a defined benefit arrangement. You give the pot of money to an insurance company, and then they'll provide a regular ongoing amount for the rest of your life. Typical rates for something like that is around 1.8, 1.9% in the UK at the moment. More commonly, because of those lower annuity rates, people are looking to do drawdown. That's where they take a percentage of the fund each year and draw down an amount to live off of. And that's normally somewhere between 4, maybe 6% a year. And then, obviously continue to grow the assets in the background. The last one is a full flexi access, or sometimes referred to as the Ferrari option. You might have seen headlines in the Daily Mail where pensioners were taking all of their pension funds out in one go and go and buy a sports car. Not something that's recommended because the lump sum could be taxed up to a rate of 55%. So quite a painful route to go and buy that sports car that way. Okay, moving on. One of the areas I'm often asked about is the dual tax agreement between South Africa and the UK. So a dual tax agreement is put in place to ensure that you aren't taxed twice when you live in one country but have assets like pensions in another. As we explained, any contributions to a pension in the UK are normally tax relief, so you get sort of a bit of a leg up from the government. And the first payment that comes out will be tax-free up to 25% of the fund. But when you take your benefit payments from the rest, if you haven't sorted out your pension structure, you may have to pay income tax rates at UK income tax rates. People often ask me, why is that? Well, because when you set up most schemes, workplace pension schemes and private pension schemes, you're obviously a UK tax resident, and the scheme will always have you on their system as a UK tax resident unless you tell them otherwise. Look, if you want to move it to a more favorable jurisdiction, there are examples of what's called a ROPS these days, a recognized overseas pension scheme. Predominantly that was in Gibraltar and Malta. You'll now lose 25% of the pension fund in an exit tax if you don't live in that jurisdiction. And this is one of the points in Brexit that's still getting resolved, whether this will even still be an option for those that want to go and live in Europe to retire. So if you leave the UK, one of the things that's essential is that you either get an NT, a no tax code from HMRC, or get yourself set up with a new scheme which knows that you're a South African resident from day one, so that when you make they make payments to you in future, and that might be 10, 20 odd years in the future, they can do so gross, so without any income tax being taken at all. So I often get asked this one: why can you get foreign pensions tax-free in South Africa? Well, that's thanks to this binding private ruling from SARS, which states from 1962, section, the 58th Act of 1962, under section 10(1) GC-2, and it says the following: it exempts from normal tax any pension received by or accrued to a resident from a source outside of the Republic as consideration for past employment outside of the Republic. So, bit of good news there, hopefully, that if you're structured correctly, then it means that you could have most of your pension income in South Africa in pounds, but without having to pay income tax on it. Now, one of the many options that you might want to consider for when you return to South African is start with understanding what you have. So we refer to this as like a free Pension MOT. It's a look under the bonnet, see what you've got, understand what it's doing. Is it a defined benefit? Is it a defined contribution? And ultimately find out how it's performing against its peers. Perhaps you might want to transfer that pension into an alternative. It's still in the UK, but potentially managed by someone based in South Africa, somebody like me, that can keep you regularly up to date on exactly what's happening with it. So kind of like swapping a red folder for a blue folder. A lot of clients will want to consolidate multiple pension pots if they've been at lots of different employers into one scheme for ease of administration and simple cost. As you say, as I said, sorry, it's like swapping a red folder for a blue folder. If it's a defined benefit, protecting your spouse and children to ensure they receive a larger amount by considering taking a cash transfer out option is very common, as I said earlier. And one of the things that you could do is create a new UK-based pension. So this isn't a pension outside of the UK, it's still there, but doing it with a specialist provider in the UK that knows that you're going to be an overseas client, or you're already here in South Africa and you are already an overseas client. So that when it comes to paying you that benefit in future, it's done so without tax being deducted. Alternatively, you could just utilize the UK NT tax code and take those benefits tax-free in South Africa. But I do warn you, that is a very challenging process between SARS and HMRC. I have one client at the moment still been trying to get theirs resolved, and it's taken about 2 years of backwards and forwards. So not something that I would recommend if it can be avoided. Okay, so if you do have a UK pension, it might be worth having a look at how it's structured and whether that's going to pay for the financial freedom or 30+ year holiday that we would call retirement. So some of the questions to ask yourself is, do you know who your pension is with? Quite often schemes get transferred from one provider to the other, and you might not be aware that it was with Friends Provident and it's now with Aviva, for argument's sake. Do you know how much it's worth today? Do you know what it's invested in? You might know the names of the investment funds that are underneath it, but do you actually know what companies they've invested in, what instruments they've invested in your pension to provide for your retirement? How has coronavirus impacted on its value? A lot of people are quite concerned about what's happened with firstly Brexit and then coronavirus, and wanting to know whether their investments have weathered that storm. But this is the most important question, the way that we approach it here at Holben, is to look at how's it performing against its peers. How fast is it going in that race? Is it going at the same speed as all those other cars that we were talking about earlier? Is it going faster? Is it going slower? Is there something that maybe you're not aware of that you might need to act upon now? And ultimately then, what will it be worth in the future? Okay, so if any of these questions have resonated with you, then feel free to contact my team, and I and my team will utilize our free pension reconnection service. And what we do is we simply go away, we contact the pension providers on your behalf, get all of the information that we've just talked about here on what you have in place, and then present you with some options on what to do next. So it's a very simple form. Do it all via DocuSign these days, so it's all electronic signatures. And then come back to you with some answers. What you'll get back from us is a very simple to read report. Okay, it will send you back, it will give you a red, amber, or green scoring, so that you understand, where your pension is compared with others. So 4 times out of 10, we'll recommend to leave it where it is. 6 times out of 10, we find that there's normally something that could be improved within the structuring that you've already got in place. So what if you don't have a UK pension? Okay, maybe you're already back in South Africa, but you want some form of an offshore tax efficient solution like a pension. Well, let's first consider the reasons why you might want to do something like that. Well, do you want to invest in currencies other than rands? Do you want to invest in something that's not affected by what the government here in South Africa does? Do you want to have investments in everything from, gold to property to Tesla stocks, all in one tax efficient solution? And do you also want an investment solution that won't be subject to things like estate duty at 20% in South Africa when you pass away? So if you've answered yes to any of those questions, then please feel free to reach out to me, and offer you some ideas about how these solutions can be made available to you, even now that you're back in South Africa. Okay, enough of my dulcet tones. So on to our Q&A session. If you haven't already done so, then please feel free to ask a question at the bottom using the Q&A button, and I'll do my best to answer them for you now. Look, I'll try my best to answer them as candidly as I can. I'm not able to provide advice in this kind of setting, so it'll be more of a general factual answer, kind of like the presentation we just had. But yeah, please do ask away. And if you'd like to know more about anything that we've discussed today, or if you have any further questions for me, then don't hesitate to reach out on the social media contact details listed on the screen now. Okay, all right. Just waiting for, oh, here we go. We've got first few questions coming in. What issues would you face with a UK pension using an NT code? Okay, all I can do, Charlotte, thank you for your question, is give you a bit of an idea of what's involved with that. So the process is that you have to get a form from HMRC. You then have to go to SARS with that form, and then SARS have to stamp it. And then only when it's stamped and approved by SARS will they then accept it at HMRC. The challenge that we've had in the examples that I've said where clients have really struggled with this is that SARS will not currently stamp overseas forms. This is where we've been backwards and forwards on a number of occasions trying to get it resolved. So unfortunately, there's an example of the kind of issues that you would have trying to resolve an NT code. So not something I would recommend trying to do yourself. Highly recommend that if you're going to do that, that you'd consider doing it using a tax consultant rather than trying to do it yourself, because unfortunately, SARS can absorb a lot of your life trying to resolve a situation like that. Okay, hopefully that answered your question there. Yeah, okay, next question coming in, again from Charlotte. So, will this cause issues with a person working for a UK company and being taxed in South Africa? Okay, so this is where we start to get onto some of the subjects that we talked about our last webinar about being a digital nomad. So, number of interesting issues there. You know, a lot of people thinking, you know, they're going to go and work for a UK company ongoing, that they're going to be on the payroll there and contribute into a UK-based pension whilst they're physically present in South Africa. The challenges are quite simply is that once you've been here about 6 months or so, then you potentially are straying into the territory where you're physically present in South Africa. What that then means is that it becomes very challenging for you to legally contribute into a UK-based pension. And actually part of the provision of the Section 10 Act that I was talking about is for services rendered outside of the Republic of South Africa. So if you're physically present here, working here, you know, and contributing to UK pension, then what you might find is that tax relief isn't available to you when you come to retire at some point in the future, unfortunately. The other thing as well is that when you're a non-UK resident, so again, once you're back in South Africa, the legal stipulations on that side of the water is the maximum you can put into UK pension is £3,600 a year. You can't contribute any more than that. The other issues that you'll often find as well, as soon as you go abroad, very often advice will stop. You know, very few advisors want to advise overseas clients. So quite often we find that clients end up in a no man's land, as it were, and that's where we get issues, for example, with the 19 billion pounds of pension pots that haven't been claimed because of situations like this. So hopefully that gives you a little bit more of an idea, Charlotte. Quite often, though, I've got clients now that back in South Africa, you know, they'll have a conversation with somebody like Janine Gelbroth at Gelbroth Rushby, who's one of our go-to tax consultants, was on the webinar the other week with me. And quite often what we'll do is we'll still use an international pension vehicle. We might use trust and other tax-efficient tools that are available to us in the wealth defence industry. But rather than it being in the UK, we might use something perhaps in the Channel Islands as an example. Yeah, so it's still primary currency. You know, it might be dollars, it might be pounds, it might be euros. It's not in rand. It's not going to be affected by a change in government policy. You know, you're not suddenly going to find that 40% of your pension's being invested in some infrastructure project, a bridge to nowhere, or re-tarmacking the same road several times, which I know is what a lot of people in South Africa are concerned about at the moment with the proposed changes to Regulation 28. So there are still those options available, but again, that's where people like me come into the equation to talk you through what those options are, so that you are as efficient as possible when you arrive back in South Africa. Okay, moving on then, let's just see if we've got some more questions here. Okay, question here from Gregory. So in what scenario is the exit fee you mentioned applicable? Does it apply if you use your pension pot to generate a monthly income? Okay, so just to be clear on this, the exit penalty is only applicable if you move your UK pension outside of the UK to another jurisdiction. Okay, so quite commonly that would be either Gibraltar or Malta, and that was what was called or is called, sorry, a CUROPS. It was called a CUROPS. It's now just called a ROPS, a Recognised Overseas Pension Scheme. Okay. Now, the rule says that if you live in that country, that's fine. You can do that without having to pay this exit tax. But unfortunately, if you move it to, say, Gibraltar and you're living in South Africa, then the 25% exit tax would apply. So quite simply, the best thing to do is leave it in the UK, and that's what the general sort of advice is at the moment. There are odd exceptions where it might make sense to look to do a ROPS. Very, very rare these days. So quite commonly what we would do, like I say, is look at the scheme in the UK and instead maybe tweak it slightly or adjust it in a way that makes it more favorable, put it into a solution that's geared around the fact you are in South Africa, but the pension stays in the UK and it normally will stay in pounds. That's normally the solutions that are put together. So hopefully that answers your question, Greg. On the second point there, does it apply if you use your pension pot to generate a monthly income? No, like I say, it's only applicable if you actually move the whole thing outside. What you'll more likely have as an issue, depending on the quantum, depending on the amount that you're taking out of your pension fund, is you're going to run into this income tax problem. And what is the income tax problem? I see it time and time again with clients, that normally it's when they try to solve issues themselves, which you're more than entitled to do. But what happens is they can't get the schemes to agree that that you're in South Africa, for one, because they often won't respond to you. They want you to write to them. They want to write back to you. And if anybody's tried to accept post, I had some Christmas cards turn up in May that were sent to me last year. So, those kind of challenges is what you'll be up against, sadly. But what will quite often happen is if you're, generating more than, say, about £1,000 a year, and you're over there for the UK personal allowance, then you'll start to lose 20% of your pension income to income tax. If you've got property that you rent out in the UK, because quite often, people that are from South Africa that went over there in the 90s and the 2000s have bought at least one, sometimes more property. So you've got property income as well. So now your income is above the threshold of 12,570. So therefore, you're going to lose pretty much 20% of your pension income. And if you can't get the arrangements in place we were talking about earlier, then your only option then would be to get into a very convoluted discussion with SARS and try and claim that money back under what's called treaty relief. And again, I've had other examples of clients that have tried to do that and still waiting for their refund from SARS. It's a very tricky area that confuses a lot of people at the tax authorities. That's the challenge. So hopefully that answers your question, Greg. Okay, I'm just going on here and see if we've got another question here on WhatsApp. Oh, hang on, let me just flick back to that. Okay, now I think we've covered that one already. Oh, right, yes, question here from Steve. Steve, thanks very much for the question. Yes, on the Channel Island solutions, are they as safe as a UK pension? Very good question, I suppose. So this is the use of a pension vehicle, probably for more often when people are back in South Africa, or they might have some discretionary money that they want to have structured effectively for their retirement. It's quite often used in that way as well. One of the things that's great about the Channel Islands is, they've had several 100 years of political stability, and they actually have a very, very good financial services compensation scheme. In the UK, if you've got a bank account, you've got cash in a bank account, £85,000 is protected per account holder per institution. Whereas if you go to the Channel Islands with some of the products that are available there, they'll protect you for 90%, sometimes even more than 90% of whatever you've got, selling cash within the structure. So, actually some would argue that the Channel Islands is safer than the UK. Their credit rating is certainly very, very strong. And if you put it in comparison to South Africa, the credit rating is about 9 levels between the likes of the Channel Islands and South Africa. So it really makes you start to look at the credit worthiness of the jurisdiction where you're going to be putting, like I said, this second biggest asset. Your property is normally the first biggest asset, and a lot of people use those to fund retirement back in South Africa. But we often forget about the pensions being a very key part of it. And part of that is because UK pensions typically have quite anemic growth or very, very low growth, and people aren't used to the better quality investment funds that could be used within a more actively managed pension vehicle in the UK. So hopefully that answers your question there. Okay, I'm going to take one more question before we wrap up. We want to try and keep it at the 40-minute mark. So if you haven't already asked your question, or if it's burning, feel free to ask it now. I'm just going to put my details back on the screen. So if you want to follow up on anything that we talked about tonight, you're not really sure on whether it's affecting you, or you want to make use of that free Pension MOT solution, then just reach out to us on the contact details here. Okay, let me just have a look. So I think I've answered that question already. All right. Well, hopefully that's everything now. So guys, thank you very much for taking the time to join me this evening. I hope it's been worthwhile. And if there's any other questions, like I say, just drop me an email or a WhatsApp, connect with me on social media. And if you're thinking about coming back to South Africa, we look forward to welcoming you back. I'm based in Cape Town. Been here for about 5 years, and I really don't plan on heading back to the UK. I really enjoy it down here. So it'd be great to meet you just for a cup of coffee or maybe a glass of wine as and when you make your trip back to South Africa. So have a great evening. Thanks for taking the time, and take care.